Here we are in week 8 and we're taking a look at our last PowerPoint of this course, and it deals with stock options. There are two main types, the non-qualified stock options and incentive stock options. Now anecdotally, I've heard from many students over the years that the ones who have taken the actual CFP exam is they do tend to test on this a little bit more than what you might think they should. So it is an important area, and it is important, of course, for you to know. Non-qualified stock options, or NQSOs, and incentive stock options, ISOs, both provide employees the right to buy a fixed number of shares of the employer stock over a fixed period of time. So they do have that in common, although the tax treatment is different for the two types of options. At the time the employer grants the employee the option, that is normally not a taxable event at the date of the grant of the option to the employee. The option price is usually equal to the stock's price on the date the employer makes the grant to the employee. A non-qualified stock option can be offered to employees as well as other relatives of the employees. There are no special requirements under the Internal Revenue Code for the non-qualified version of stock options. Employers can grant them on any terms. They can be exercised over any period of years in which the employer wishes. The option can be granted to employees of the company, but also to independent contractors, family members of employees or independent contractors, or beneficiaries of the employee or independent contractor. Now we take a look at how the non-qualified stock options are taxed. When an option is exercised to purchase the employer's stock, there is then immediately W-2 income, and payroll taxes are taken out on the difference between the option exercise price and the current fair market value of the stock. After the exercise is completed, the basis in the stock is going to be equal to the exercise price of the option plus the ordinary income that is recognized on the tax return. When the shares are sold or acquired through the exercise, it results in either a capital gain or loss. The holding period depends on the length of time that the stock is held from the date of exercise. If it is held for 1 year or less, it is taxed as a short-term capital gain. If the stock is held for more than 1 year, it is taxed as a long-term capital gain. Incentive stock options have much more formal tax implications and regulations. ISOs must be part of a written plan that is approved by the company's stockholders. The exercise period given to the employee, which is usually an executive of the company, can be no longer than 10 years from the date of the grant. The option price cannot be less than the fair market value of the stock at the time of the grant. ISOs may only be granted to employees, not independent contractors or family members. They are not transferable during the employee's life. However, they may be transferred at death by will. The ISOs must be exercised within 3 months after the employee retires or is terminated. To obtain favorable tax treatment, the shares must be held at least 2 years from the date of the grant, and also at least 1 year from the exercise of the option. Here are the tax rules for incentive stock options. There is no regular taxable income upon exercise of the option. However, there is an AMT adjustment, so therefore AMT taxes might need to be paid on the bargain element. The bargain element is the difference between what the employee can buy the stock for and the fair market value of the stock. The basis of the stock for regular tax purposes is the option exercise price. The basis for the AMT calculation is the market price of the stock on the date of the option exercise. If the stock is sold within 1 year from the exercise date or within 2 years from the grant date, then ordinary income tax is reported on the W-2, but there are no payroll taxes taken out for unemployment insurance or Social Security or Medicare. If the stock is sold after 1 year from exercise and after 2 years from the date of the grant, then the stock gain is taxed as a long-term capital gain.